Welcome to Real Clear Radio Hour, brought to you by the Competitive Enterprise Institute. I'm your host, Bill Frezza. This week, we take a global perspective on finance and culture. In the second half of our show, up-and-coming Australian blogger Claire Lehman shares her views on the excesses of contemporary feminism and clickbait journalism, particularly as these conspire to inflame digital mobs. Up first, we have former merchant banker, market analyst, and author Martin Hutchinson, publisher of The Bear's Lair, with some cautionary words about the bust that always follows the boom. Martin, welcome to the show.
Oh, thank you. Great to be with you.
Martin, how does it feel to be a world-renowned bear in such a bull market?
Very embarrassing. I'm only glad I didn't start being a bear in 1996, at which point I'd have been completely zapped and drummed off the stage within my first 4 years. As it is, I'm lucky. I started my Bear's Lair column in November 2000, which was a pretty good year to start being a bear, and of course 2007 would have been even better.
Well, you called a couple of big downturns, but like other people who can't believe this is still going on, it is still going on. And I suppose we ought to start with Japan, since that's where the pain has been prolonged the longest. What's the situation in Japan? And then we'll move on to your prognosis.
Well, they've been in a downturn since 1990. And it's not a proper full downturn in the sense that they get a tiny amount of gross domestic product growth and more or less zero inflation, and they've had that now for 24 years.
A whole generation.
A whole generation. And starting in 1992 or so, they decided that Maynard Keynes was the way to go, and that therefore budget stimulus was what they were going to try and do. And so they did budget stimulus after budget stimulus after budget stimulus, all sorts of spending plans. And then in the late 90s, they dropped interest rates to zero and kept them there. And indeed started buying bonds later on after that. And they're now buying about 3 times as many bonds as the Federal Reserve was at the height of its QE3 boom. And they're still doing stimuluses. I mean, this guy Abe came in 2 years ago and said he was a new boom. Then the first thing he did was spend another $100 billion in extra spending on infrastructure of some kind.
Hasn't their argument been that if it weren't for the stimuli, plural, things would have been worse?
Well, maybe, but they've driven their debt up to 240% of GDP. And at some stage, things will get a lot worse. Short-term palliatives are all very well, but the long-term does get to you in the end. And I think we're getting pretty close to it being there.
As long as the market keeps buying their bonds, why shouldn't they keep selling them?
The largest debt-to-GDP ratio that's ever been cleaned up without default is 250% of GDP, which the British did twice, in 1815 after the Napoleonic Wars, and in 1945 after World War II. And in 1945, they did it the easy Keynesian way by causing a bloody great inflation and making bondholders lose their money. And in 1815, they did it the hard way by cutting government spending until the income exceeded the outgoings. And that worked much better, and they didn't have any inflation over the course of the 19th century. They brought the debt down a bit, but GDP increased so much that the debt was trivial by 1900.
They grew out of it.
They grew out of it, yeah.
That's often the remedy to a lot of these problems is growth, but that seems hard to find pretty much anywhere in the developed world these days.
Well, I think the disease may be caused by the politics themselves. I mean, if the government spends more money, then it's probably doing so in a less efficient way than the private sector would spend if the private sector was given it to spend. And it is, of course, draining the resources from the economy some way or another. The government doesn't create money except marginally when it prints some. And so either it's borrowing it in the bond markets or it's borrowing it from the central bank. And eventually the diversion of resources into the public sector drags down growth. And you can see it in, well, for example, Britain, where public spending was very high after World War II and growth lagged every other country in the world pretty well. And you can see it in Japan, where public spending's gone from 30% of GDP in 1990 to over 40% now. And they're saying, they can't possibly cut the budget. Well, they could if they really wanted to.
What role does demographics play in Japan's problem? I understand they sell more adult diapers there than they do baby diapers.
I think demographics means that the GDP numbers are higher than they look, in the sense that a 2% growth in the US, 1% of that is population growth, and so it's really only 1% per capita. Mm. Whereas in Japan, they have slightly negative per capita growth. It's not heavily negative yet. And so a 1% growth is a real 1%, or maybe even a real 1.2%. So to that extent, their figures are better than they look. Now, the obvious other problem is that they've got a lot of retirees, and so they've stopped saving because retirees spend their money. They don't go on saving it. And that has put rather more of a burden on the economy.
Don't the Keynesians say that spending is good, and therefore as more people stop working and spend their savings, the economy should grow?
Well, yes, they do, and they also say that if government spends it, the economy should grow better. But I have to say, I look more at the sort of production rather than the consumption. I'm not sure consumption really causes economic growth. In fact, I'm fairly sure that it doesn't. Whereas on the production side, it seems to me that Japan has fewer workers per retiree than it did 30 years ago. And so that's obviously a drag, but it's not enough of a drag to cause the whole problem. And of course, really, if you've got a big burden of retirees, you want less government debt, not more.
If their capital base moves offshore to China or other parts of Asia along with their factories, but it's still Japanese shareholders earning their returns, what's the problem with that?
Well, the Japanese don't have any jobs because the Chinese and the other offshore guys are doing all the work. You could have a society entirely of rentiers, but in fact the Japanese capital base isn't growing because the government's borrowing money and private sector saving has shrunk from 20% of GDP to something fairly close to zero. It's only a couple of percent now.
So wind the clock ahead. If things continue as they are in Japan, how does their story end?
I think it all depends on the bond markets. I think at some stage the domestic savings pool can't absorb massive extra bond issuance from the government. And at some stage, the international investors won't go on buying Japan government bonds. And if you had a bond market decline where yields went up, you're at the stage now where you could very quickly turn that into a panic. In other words, that would escalate pretty quickly. Yields would go up to 1%, 2%, 3%. And suddenly everybody would do the arithmetic and say, oh my God, the Japanese deficit is now how many trillion yen it is. It's now 20% of GDP instead of 8%. And the bond markets would panic and the government would then be unable to finance itself. And so that, I think, is the most likely trajectory. And I think we're probably only a couple of years off it, given that the deficit is 8% of GDP. And it's now 5 years since the bottom of the recession. So they're running this 8% of GDP deficit really without any excuse and without any obvious sign that it's ever going to diminish. Indeed, Abe is talking about further spending plans.
Martin, as we move west toward Europe and we hit our first stop in Greece and Cyprus, what's going on there?
Well, Greece, I think, has had a rotten 5 years. It's just beginning to recover. But I think the politics may overcome it because the left-wing Syriza party is running very high in the opinion polls. I would see within the next 12 to 18 months a Greek government getting elected that no longer wants to do the austerity that the EU is telling it to do. And at that point, presumably Greece leaves the euro. And
you really think they would walk away and repudiate their debt?
If they leave the euro, they might, well, there'll be some sort of rescheduling, just as there was with Argentina, but it would be a fairly similar situation, I think.
Who ends up on the short end of that? With so much of this debt covered by credit default swaps, if you net it out, who ends up the loser there?
I'm not sure.
Probably everybody. It's in every nook and cranny of the economy.
But there isn't that much of the Greek debt. I think there's only sort of 5 billion of Greek debt covered by credit default swaps.
Okay, so
because Greece has been such a bloody awful economy since the credit default swap market got big.
No one wants to take the other side.
I'm not sure anybody ever did it.
Well, what happens when we get to Italy? Now, that's a much larger economy. The numbers look pretty ugly. There's probably a lot of CDS coverage. Where's Italy heading?
I think the country I'd worry more than Italy is France.
Really?
Italy is currently more or less acceptably run. It's never had a huge budget deficit because actually it was very acceptably run under Berlusconi, who kept the budget under control. And they haven't had much growth or got much growth, and the government's too big. But the numbers don't suggest that it's spiraling out of control, even though they have too much debt. They're at 120% of GDP as against Japan's 240. So they got a bit more room to maneuver there.
Plus, I think their underground or black market economy is so much bigger in Italy than other parts of the world that it's not counted in the GDP.
Well, that's right, yes, but you can't tax it. So it doesn't do as much. I mean,
it provides
it
jobs.
makes them feel good, but it doesn't do as much good as it might because you've still got the budget deficits and you've still got the debt. You can't use underground money to pay off public debt. So Italy's a long-term problem, but I'm not sure it's a short-term problem. Whereas France, I think, is the other way around. I think France, perfectly good economy, presumably in the long term, doesn't have grossly excessive amounts of debt, but it has a truly awful government.
Well, spend a little time giving us that picture.
Well, the French were supposed to be a strong economy like Germany 2 or 3 years ago, and then they elected Hollande, and he put the top rate of tax up to 75% and started stimulus spending programs. And they have, I believe, fairly recently rejected the EU's latest recommendation as to where their budget should be, with the result that they're running down the same track that Japan, although Japan's well ahead of it. But of course, France has the disadvantage that it doesn't control its own currency. And so default is perhaps closer than it is with the Japan, where the central bank can print money when it needs to.
I think Hollande's approval ratings have fallen below Obama's, so there's clearly some unhappiness there. Could there be a change of government?
Yes, I think it's a fixed-term system, and they're still a couple of years off the election. In the long term, obviously, there can be. I don't think there'll be a crisis that removes him. Obviously, I mean, France has negative political risk, if you like, in the sense that any new government would be an improvement. You've always got to watch that, because negative political risk can change a picture very quickly.
I got to remember that one. And the Germans are paying all the bills right now. How long will they continue doing so?
Well, I think the Germans are allowing the European Central Bank to start buying bonds of the dodgier countries of Europe. And the crisis will presumably be, I guess not a Cyprus, it's too small, but a Greece or maybe even a France, when the bond market stops accepting the paper. And I'd see that happening within the next year in Greece. I just think that the solution with Greece is to chuck them out. I don't see Germany politically stopping paying the bills, at least in moderation, because it's already got a centre-right government. It's a grand coalition, but Merkel's the chancellor. And so there the political risk is negative, not positive, because the Alternative für Deutschland is very unlikely to get into power.
But growth has pretty much stopped in Germany. How long will they put up with that?
I'm not sure. Yeah, I'm rather more bullish on Germany than most people. I think the growth has only stopped temporarily. The thing is that their cost structure is better than most other countries in Europe, and they're exporting like crazy. And the euro is being driven down by the European Central Bank printing money. And so the German export machine should pick up, and I'd see Germany swinging back into growth again.
Which would probably be good for the world economy. What does all this mean for us here in the U.S.? Unemployment is down. The stock market is at an all-time high. Isn't life good?
Well, I think you can see the costs of the last decade's policies in things like productivity growth, which is very low. It's down around 1%, whereas the long-term average is certainly 2% and was closer to 3% before 1973. My thesis is that regulation is what's put the lid on productivity growth over the very long term, because the downtick in the 70s where it dropped from 2.8 to 1.8, roughly, over the next 20 years, coincides with the advent of the big regulatory agencies, notably the EPA, but also the Office of Safety and Health, whatever it's called.
OSHA.
And so I think the advent of much more stringent government regulation has permanently put a crimp in productivity. And then in the last 5 or 6 years, you've seen productivity growth even lower. Well, it's not surprising, since the current administration loves regulation and is throwing them around like there's no tomorrow.
Isn't the claim, though, that we're getting other societal benefits that make for a better life?
We clearly are to a limited extent. The Cuyahoga River's not on fire. Equally, if you take 1% productivity growth over 40 years since 1973, or 41 years now, we would be close to 50% better off if we hadn't had EPA, if EPA is indeed the cause of the productivity decline. Now, there's a point at which it's worth paying for the occasional river being on fire, because 50% is a lot.
So how do you strike a balance? Clearly, I was in China not too long ago. I wouldn't want to breathe the air over there. I remember what the air was like here in the 60s. I wouldn't want to breathe that air either. When do we reach a point of diminishing returns on regulations, and how do we stop?
Well, that's the problem. Clearly, I breathed the air in Washington when I first came here in 1970, and it was pretty disgusting. So the initial environmental regulations were a good thing. And if they had put them in and then stopped, you'd have had a one-time hit to GDP. Maybe you'd have lost 5% over a 5 to 10 year period. And then after that, GDP growth would have blipped back up again. But of course, the problem is, once you've got the bureaucracy, it keeps thinking of new regulations it wants to impose. And you've got this whole global warming thing, which is an excuse to regulate absolutely everything and sort of shut down the coal industry and so on. And you've got things like the Keystone Pipeline. I don't think it's true now, but certainly as of 2012, the cost of the Keystone Pipeline was something north of $20 billion a year of delay in the Keystone Pipeline, because that was the differential between Canadian oil prices and U.S. oil prices for the volume of oil that would go through the pipeline that didn't yet exist. Now, the differentials have narrowed since then, but even so, you don't need to run very many years at $20 billion a year to pay for an awful lot of pipelines. And you've got things like you can't build a nuclear power station in under a couple of decades. It's not so much the regulations themselves as the additional time costs that they impose. Another example is infrastructure. The tunnel between New York and New Jersey, which Governor Christie zapped, was going to cost something like $9 billion. Well, it was pretty well identical to the Holland Tunnel, which they built in the 1920s, opened in 1927, cost $48 million with an M. All right, costs in 1927 weren't what they are now. You multiply it up by the inflation factor between the 2 years, you're still only at $700 million. And so the difference between $700 million of a 1927 tunnel and $9 billion of a 2014 tunnel is pretty inexplicable until you start looking at the costs of the various regulations involved, and to some extent union labor. It's
the opposite of Moore's Law. Everything's getting cheaper in the electronics world, and everything's getting more expensive in pretty much any industry the government touches.
Yeah, certainly any industry they fully regulate, yes.
Let's look at the trends for a minute, though. We talk about the impact of global warming on our politics. It's been, 17 or 18 years now that global temperatures have been fairly flat. How much longer can they keep that story going before the body politic turns against it?
I think the body politic already has turned against it. But of course, if we suddenly see temperatures blip up for a year or two, the environmentalists could have another go. I'm not sure what the reality is. I don't think anybody is. What I am fairly confident of is that while global warming may well exist, and, anthropogenic global warming, in other words, not just the climate going up and down on its own, there may be some, but there appears to me every evidence that it's less than a degree by 2100 degrees centigrade, so 2 degrees Fahrenheit. And if that's the case, it's not something to worry about.
Well, it's hardly worth destroying the world economy for.
That's right, absolutely.
To bring it back to a personal level, what should Americans nearing retirement be doing with their investment savings right now?
Damn good question.
And I have no personal interest in this, being 60 years old.
No, well, that's right. I'm 64 myself. I've also got no personal interest in it. Well, if you don't own a house, buy one, but somewhere cheap.
Yeah.
That's clearly a good investment, but stay out of the big cities because they've got inflated. But U.S. real estate is cheap by global standards. So, I mean, my Poughkeepsie, which is a little bit above sort of the plains of Iowa, but nevertheless not that much.
Good, safe place.
Is a decent place to buy a house, and you're only 70 miles from New York. And I think anybody retiring and saying, well, we don't want to go out into the middle of nowhere or to somewhere with no facilities, the recommendation is find somewhere cheap, but don't rent because it's an inflation hedge.
How much exposure should people have to the stock market right now?
I would be, as much as possible, international, not U.S. I think the international stock markets, particularly emerging markets, haven't had the run-up that the U.S. one has. And also, they haven't had the run-up in earnings that the U.S. one has. The U.S. earnings are at a record percentage of GDP. So when you say the market's only on 20 times earnings, the answer is yes, but the earnings are at sort of 11% of GDP, and the historical average is about 7%. So, you know, normalized earnings, as Professor Schiller puts it, you're on about 30 times earnings at the moment.
So what words do you experts use? The market's fully valued?
I think the market's, more than fully valued. You know, at some stage, this whole lot has to come crashing down. And I don't think we're talking about another Great Depression. I don't think we were ever like to have a Great Depression in 2008 either. And I don't think it'll be the banking system that causes it. It may well be Japan that causes it. But, you'll have another dirty Great Recession and the stock market will drop to Dow 5,000 or thereabouts. And then hopefully we'll have sensible monetary policy and won't just reinflate it. Because if we go on creating these bubbles, then eventually the US will have government debt of 200% of GDP and will default. And that would cause a major destruction of national wealth.
So, Martin, how does a bear maintain hope?
Well, by looking at the long term to some extent. In other words, by saying, well, there's a dirty great crash coming, but we can hedge against that. And over the long term, the scientists, the technologists, and so on are producing wonderful new stuff. And if you can only get the regulation a bit lighter and get the monetary policy a bit better, then we haven't gone ex-growth. I don't believe in Professor Gordon's theory, I think it's Gordon, that we've invented everything we're going to invent and therefore finished with growth. I think there's a lot more growth to come, but we've got to have the right policies to get it.
Martin, you've given us a lot to ponder. Thanks for being on the show.
It's been great being with you.
That was Martin Hutchinson, publisher of The Bear's Lair, here on Real Clear Radio Hour, brought to you by the Competitive Enterprise Institute. I'm your host, Bill Frezza. To send us comments and feedback on this or any of our past shows, visit realclearradio.org and click on the Email Bill link. Real Clear Radio Hour is a partnership with Real Clear Politics, one of America's top political websites. Ahead, Australian blogger Claire Lehman gives us a culture war sanity checkup. Stay tuned.